Hey there, this is David from Rent to Grow Homes. Today I'm going to break down our recent rent-to-own deal, this one taking place in Windsor, Ontario. We are looking for an investor, so hopefully at the end of this video, if this is something that's interesting to you, please reach out to me and we can talk further. So Terri and Brice are in Windsor, Ontario. We've been talking to them for about 3 months now, went over all their paperwork, talked to them many times, did some Zoom calls, and I've decided that they are absolutely worth the investment in terms of their story and why they're in rent to own. So today's video really goes over the numbers. Their combined income is $145,000. So my mortgage broker has approved them for a budget today of $500,000. What that means is they can go work with their realtor and find a home that they like, but the max that we're going to spend, the most that they can spend on this house is $500,000 today. So that's their budget. So really kind of this calculation is based on the most that they could spend. It's possible they're going to find a home at $460,000, $480,000, and we adjust the numbers accordingly. These calculations are done at $500,000. So as you can see here, $500,000 is our starting budget. We assume the market will appreciate 5% per year, and this is pretty standard across Ontario. If you look at sort of the history, that's generally what the appreciation has been in good markets. And the length of this deal is 3 years. What this means is at the end of 3 years, they will be buying the house from you at this new price of $578,000. How do we get to this number? We basically take $500K, assume 5% increase per year. Of course, it's compounded, and we get to $578,000. Now, in terms of the purchase today, we would be getting a mortgage. So the investor would be putting 20% down. 80% would come from the bank. So $400K comes from the bank. Interest rates, for this model, I'm using 5.75. I've heard some 5.4s, 5.5s lately. So I'm fine if this goes down. Even if this goes up to 6, the model still works for this deal. But I suspect we'll probably get in the 5.4s, 5.5s. So 20% goes to the bank. Cash to bank is $100K. Legal is $2,500. Land transfer tax is $64.75. I collect a fee for Rent to Grow Homes up here at $4,000. Now the tenant buyer is in for $40K. So they've got some significant skin in the game. They're using this as their initial down payment. The reason they're using an amount this large is they want to get to over 10% at the end of 3 years. So they're starting at around 8% now, and then we'll help them get to 10%. So if I take this 100K, add this, and subtract this, this means the investment from the investor on day one is $72,975, and that's the number we use when we calculate the return that I owe the investor. And for this deal, we are assuming 23% annual return, or a total of 69% over 3 years. Now let's talk about the money as it comes in and goes out. So each month, they're going to be paying rent of $2,800 as well as an option credit of $600. This rent is meant to come close to covering our expenses of mortgage payment, insurance, and property taxes. I've estimated these two for now, and I know I've sort of estimated on the high side. There's a good chance this comes down. These add up to $2,884. The rent's $2,800, so we're a little bit below, but I'm okay with that because they're also paying us an additional $600 a month for their option credit. This $600 is basically goes back to them. So the entire $600, 100% of it goes back to them at the end of 3 years, but we're basically forcing them to save. So we know exactly how much money they're going to have left at the end of 3 years. So each month they're paying us $3,400. We are paying out $2,884 in terms of the 3 big expenses of mortgage payment, insurance, and property taxes, which means our cash flow each month is $516. So the investor will be getting an e-transfer from me every month for $400. So at the end of each month, you have a positive cash surplus of $400 coming to you. I take a $100 property management fee each month, and that leaves $16 that we would just leave into our joint bank account. Now, let's fast forward 3 years when we have agreed to sell this house at $578 to the tenant buyer. So we're going to return their $40,000 initial deposit. We're going to return $21,600, which is 36 months times that $600 option credit they paid us every month. The mortgage discharge is this, and obviously we started at $400,000, but mortgage payback occurred. So now our mortgage is $383,000. We've got legal closing costs to sell the house to the tenant buyer. We pay our investor back the $72,000. So this is the amount of proceeds from the deal at sale. Now let's look at the overall deal profit. So appreciation, well, we started at $500K, we went to $578, so we're making $78K of appreciation. We're making $16,000 on mortgage paydown. There's a negative amount on rental cash flow. Of course, this was kind of counteracted by the option credit, but in true accounting fashion, it is a negative cash flow. So if I add these three up, we have $92,000. We had the two legal as well as the land transfer tax. And then I had to pay a referral fee for this particular deal. So the total profit on the deal is $75,000. Now, the investor was in for $73,000. I'm promising 23% annual return times 3 years, which is 69%. So if I multiply that 69% by the initial investment, I get a total here of $50,353. And that is the profit for the investor to make on this deal. Now, part of that $50,000 was paid in monthly cash flow. If you remember, you were getting an e-transfer every month of $400 times 36 months. So $14,400 was paid to you monthly. And if I subtract this $14,000 from the $50,000, that means just under $36,000 is owed to you, and you would get paid this amount when we sell the house in 3 years. So just to summarize here, you're in for almost $73,000. You're going to be making 69% overall over 3 years, and that's 23 times 3, which means your total profit on the deal is just over $50,000. You're going to get about $14,000 of that in monthly cash flow of $400 a month for 36 months. And the remainder of that you will get when we sell the house in 2027. Now, in terms of how I make money, I had a fee up front of $4,000. I collected $100 a month in property management, and then I get the remaining proceeds from sales. So typically the investor gets paid first, and then I get what's remaining, which means my profit on this deal is $25,000. So we look at the total profit again on the deal. You got $50,000, I got $25,000, which means you're getting, effectively the investor is getting 2/3 of the pie, 2/3 of the profit. I'm getting 1/3, and that's generally what I try and focus on. That's the general split that I use: 2/3 for the investor, 1/3 for me. And that really summarizes it. So if this is interesting to you, please get in touch with me. Send me an email, send me a DM, send me a text. My information is here, and I'd be happy to talk to you. Thanks.